Here's what's going viral right now: one company, two prices. For $1 trillion. 1.75 trillion. Same rocket. July 2026. Wall Street's biggest banks published their first ratings on SpaceX, the largest stock market debut in history. One bank calls it the apex of civilizational ambition. Price targets stack up: $225, $255, $300. Then one research firm breaks ranks. Its target: $131, for dollars below the IPO price itself. Its reasoning, in writing: no credible financial model gets you to $2 trillion. Not today. Run the spread. The most bullish target implies roughly $4 trillion. The bear case: under 1.8, $2 trillion apart. $2 trillion is not a rounding error. It's roughly the yearly economic output of Italy, appearing or vanishing, depending who's right. Professionals with the same filings, the same spreadsheets, the same rocket, landing $2 trillion apart. That isn't analysis. That's a question. 3 questions, actually. How was $2 trillion built? Why does one analyst call it impossible? And who pays if he's right? Over the next 18 minutes, we audit the biggest IPO in history, verified and labeled. This is the $2 trillion question. Start with what actually happened, because even stripped of every adjective, this listing rewrote the record books. Earlier this summer, SpaceX, the rocket company founded in 2002, finally went public, priced at $135 per share. At that price, the company was worth about $1.8 trillion before a single public trade. For scale, that's more than every major automaker on Earth combined. For a company selling rocket launches and satellite internet. Then the pop. Within days of trading, the market pushed the valuation past $2 trillion. $2 trillion placed it among the 5 most valuable companies on any exchange, anywhere, instantly. And unlike the giants standing beside it, this one had never published a public earnings report in its life. Who was buying? Everyone. But the order book tells the story in layers, and the layers matter. Layer 1. Institutions, pension funds, sovereign funds, asset management giants, who received allocations at $135. Layer 2. Retail investors who could only buy once trading opened, which means after the pop, near $2 trillion. Hold that gap between $135 and the pop. Who buys at which price becomes this film's final chapter. First round of guess the number. How much cash did the biggest IPO in history actually raise? Lock it in. More than $30 billion, clearing Saudi Aramco's $29.4 billion, the record that stood since 2019. Context: Alibaba's 2014 record was $25 billion, Aramco's, $29. Records that stood for years, passed in one morning. Why did the market absorb it so easily? Because this company arrived with a story no spreadsheet had ever priced. The track record is real. Its Falcon 9 rockets landed and reflew boosters hundreds of times, turning launch into a routine. By 2025, it was lifting more mass to orbit than every other company and country on Earth, combined. Its Starlink constellation, thousands of satellites, sells internet to millions of subscribers in places cables never reached. Real rockets, real revenue, real customers. Nobody in this film disputes any of that, including the bear. Because the $2 trillion question was never whether this company is impressive. It's whether impressive is worth $2 trillion. To answer that, you do what the banks did, build the number from parts, one assumption at a time. And when you actually stack the pieces of $2 trillion, one piece is doing almost all the lifting. Welcome to the machine room. This chapter is the actual math, plain language, clearly labeled, no rounding tricks. Rule 1 of valuation. A company is worth its future profits, discounted back to today. Everything else is decoration. Rule 2. At market average multiples, $2 trillion of value needs roughly $80 billion of profit. Every year. $80 billion is elite territory. Apple, the most profitable company on Earth, earned about $94 billion last fiscal year. So the claim embedded inside $2 trillion is simple. This rocket company will one day earn Apple-class profits. Hold that sentence. Now open the actual businesses. Where could 80 billion a year possibly come from? Start with the famous part, rockets. The entire global launch market, every rocket, every country, every payload, generates roughly $15 billion a year. Read that again. Owning 100% of Earth's launch business buys $15 billion in revenue. The math doesn't reach. Guess the number, round 2. In the bank's own models, what share of this valuation do rockets carry? Lock it in. In the published notes, typically under 15%. The launch business, the famous part, is the small slice. So what's the big slice? Look up. About 340 miles up. Starlink. Satellite internet sold by subscription, millions of customers across more than 100 countries, growing every quarter. Analysts peg Starlink's revenue in the low teens of billions per year, already several times the company's launch income. The bull case scales that curve, hundreds of millions of subscribers, aviation, shipping, defense, broadband as a planetary utility. Morgan Stanley's $300 target leans on exactly this, Starlink as the cash engine, rockets as the moat around it. Deutsche Bank's 255 builds similar scaffolding. Launch dominance, Starlink growth, and margins expanding as the next rocket arrives. And then there's the third ingredient, the one that isn't a business at all, the one the poetry is really about. Mars, the multiplanetary story. In valuation terms, an option on markets that don't exist yet, priced anyway. The apex of civilizational ambition. That is a real sentence from a real bank's initiation note about a stock. Here's what that sentence does financially. It licenses a premium no cash flow model has to justify. Belief capitalized. Add the parts. Rockets. Maybe 15%. Starlink's curve, the bulk. And a civilizational premium bridging whatever remains. That's how 2 trillion is built. Not fraudulently, not carelessly, but on one load-bearing assumption stacked on another. Assumption 1. Starlink growth never stalls. 2. Margins survive physics and competition. 3. The next rocket works on schedule. Every bank publishing a buy rating stress-tested those assumptions and concluded, probable enough. Reasonable people did this math. But one firm ran the same numbers, the same filings, the same rocket footage, and reached for a different stamp. Its conclusion, published the same week. There is no credible financial model that justifies $2 trillion. Full stop. Welcome back. Meet the Dissent, because in a $2 trillion chorus, the quiet voice is the story. MoffettNathanson, a boutique research firm with a reputation for unsentimental math, and no underwriting fees in this deal. Their rating neutral. Their price target, $131. For dollars below what IPO buyers paid. Sit with that. Their model says day one investors slightly overpaid, and the $1 trillion pop above it is pure air. The quoted line, no credible financial model reaches $2 trillion. Yet. Note the yet. Is doing real work. What does the bear model see that the bulls don't? 3 walls. Walk them with us one by one. Wall 1, the addressable market. Starlink's natural customer is someone fiber can't reach. That's a big market, not an infinite one. Dense cities where the money lives already have cheaper, faster ground internet. Satellites win where wires lose. Mostly. Wall 2, capital intensity. These satellites deorbit and burn within about 5 years. The constellation isn't an asset, it's a subscription. Thousands of replacement satellites, forever, plus the rockets to loft them. Growth and maintenance ride the same budget line. Wall 3, competition wakes up. A rival megaconstellation from Amazon, state-backed constellations abroad, subsidized fiber below. Pressure from 3 directions. None of those walls says the company fails. They say the curve bends. At 2 trillion, the price assumes it never bends. That's the entire dispute. Bulls price the dream trajectory. The bear prices the trajectory with friction. 2 trillion sits between. Is a below IPO target radical? Look at the incentives around it because they're part of this story too. Structural fact. Several banks now publishing by ratings also underwrote this IPO, collecting fees on the deal they're grading. That's legal, disclosed, and completely standard. It's also why loan dissents earn attention. The incentives lean one direction. Research backs the pattern. Underwriter-affiliated analysts historically skew more optimistic on fresh IPOs than independent firms do. So, a chorus with fee income and a dissenter with a spreadsheet. That alone proves nothing. Evidence settles it. And in every model on both sides, the evidence question funnels to one machine, the one every target above 200 quietly depends on. Starship, the largest flying object humans have ever built. The promise, 10 times cheaper for times the payload. If that machine delivers, the bull math starts breathing. If it slips, 131 starts looking generous. So the real fight was never about the stock. It's about the rocket. What's proven, what's promised, what's pending. Every valuation argument in this film funnels into one steel tower on a quiet coastline. Here's the honest status report. The design goal is public. Full reusability. Both stages return, refuel, and refly, like aircraft, not ammunition. Why that matters financially? Today, most of a launch's cost is the rocket itself. Burn it once, bill the customer. And the company already half-proved the thesis. Falcon 9 boosters refly routinely, some individual boosters more than 20 times. Reuse demonstrably cut prices. Falcon 9 undercut legacy launch pricing so hard that competitors exited entire market segments. So, reusability lowers cost isn't a fantasy. It's a documented, decade-long, verified precedent. Credit where it's due. Starship's promise is that precedent, cubed. And this is where verified quietly hands the microphone to promised. Promised, 100 tons or more to orbit per flight, several times today's workhorses, at a fraction of the cost. Final round of guess the number. A Falcon 9 launch lists near $70 million. Starship's promised cost? Lock it in. The stated ambition, under $10 million per flight. Some public remarks go lower toward 2 or 3 million. Eventually, 70 million down to 10. That's the tenfold in every bull note. Notice, it's an aspiration, quoted as an input. Now the evidence column, what this machine has actually demonstrated, as of the week this film was published. Verified, repeated integrated test flights, boosters caught back at the tower, ships surviving re-entry, real filmed public milestones. Not yet demonstrated, rapid reflight of the same vehicle, orbital refueling, commercial payloads at scale. The economics live there. That's not an insult, it's a sequence. Falcon 9 needed years between first landing and routine reflight. Physics doesn't rush. But evaluation is a clock. $2 trillion today prices those economics arriving roughly on schedule, and schedules here have history. The company's own targets have slipped before, Mars cargo timelines, this rocket's debut year, early cost curves. Publicly, repeatedly. Bull's answer, it slipped, then delivered anyway. Landing rockets was called impossible too. That rebuttal has real receipts. Bear's answer, delivering late is fine for a company. It's expensive for a stock priced as if late never happens. One more wrinkle. This rocket's biggest early customer is the company itself, launching Starlink. Revenue circling inside one balance sheet. Internal demand is real demand, but it makes outside verification harder, costs, prices, margins, all family accounting. So here's the honest scorecard. Physics, demonstrably ahead of the doubters. Economics, still a promise wearing verified clothing. Which means $2 trillion is, functionally, a bet on a test program. That's not cynicism. That's the prospectus. Markets have made exactly this bet before, pricing the future as finished. We have decades of receipts on how that ends. Welcome back. Final stress test, history. Every era swears its miracle stock is different. The ledger keeps score anyway. 1997. Amazon lists at $438 million. Critics call books a niche. 5 years later, down, mocked, and compounding. 2000. Pets.com goes public in February and liquidates in November. 268 days, start to finish. 2012. Facebook prices at $38 amid frenzy, and halves in 4 months, then earns it back tenfold. 2021. Rivian, an EV startup worth more than Ford and GM combined, on almost no revenue. 2 years later, down over 90%. 2019. Aramco, the previous record IPO, raised $29 billion, then mostly traded sideways for years. Records guarantee nothing. And 2010. Tesla lists at $17. Bleeding cash, shorted relentlessly. You already know how that chart ends. 6 stories, 2 lessons. And the uncomfortable part is that both lessons are true at the same time. Lesson 1, hype fades. Most heavily hyped IPOs underperform the market across their first 5 years. That's the documented base rate. Lesson 2, the exceptions pay for everything. 1, Amazon covers a graveyard of pets.coms if you survive the crash between. So the question isn't, is SpaceX real? Amazon was real. Rivian's trucks were real. The variable was always the price. At $2 trillion, how much of the future is already spent at checkout? History's answer, usually most of it. There's one more rhyme, and it's the strangest, because we have priced a world-changing transport revolution before. The 1840s, British railway mania. Investors funded thousands of miles of track for a transformed world. The world did transform. The railways got built. The economy changed forever. And most railway shareholders of 1846 still lost their shirts. Technology succeeding and investors profiting are two different events. They correlate. They do not guarantee each other. Which reframes our title. Mars may get its city. Starlink may wire the planet. And $2 trillion could still be the wrong price. So the last question is the oldest one on Wall Street. If the price is wrong, who exactly is holding it? Follow the shares. Who owns this bet, at which price, with whose money? The answer comes in 4 tiers. Tier 1, insiders and early venture funds. Cost basis, pennies to dollars. At any public price, they have already won. Tier 2, IPO institutions at $135, pension funds, sovereign wealth, mutual funds. Your retirement may already be aboard. Tier 3, everyone who bought the pop, retail traders entering near $2 trillion, paying the highest price with the least information. And soon, Tier 4, index funds. If the stock joins the big benchmarks, millions become shareholders automatically, no opinion required. Now map the risk. If the bear is right, Tier 1 stays rich, Tier 2 bruises, Tiers 3 and 4 absorb the repricing. If the bulls are right, the same pyramid pays out in the order everyone forgets. Latecomers profit least. Again. Notice what's constant in both futures. The people with the least information carry the widest range of outcomes. That's structural. One date to mark. The insider lockup expires 180 days after listing. Watch what Tier 1 does with permission. Because insiders can be wrong about value, but they are never confused about price. Verdict time. So, the $2 trillion question. Here is the verdict this film can actually defend, labeled to the very end. Verified, the greatest launch company in history. Real reuse, real Starlink revenue, real records. The company is not the controversy. Analysis. The price assumes Starship economics, unbroken Starlink growth, and a civilizational premium. 3 promises stacked, none yet bankable. Between those 2 rows sits the $2 trillion disagreement, and this film will not pretend to referee it. Nobody credible can, yet. Replay our opening counter one last time. For trillion, 1.75. Same rocket, same filings, 2 trillion apart. What settles it isn't opinion, launch cadence, subscriber counts, and the first audited earnings report in company history. All dated, all coming. We'll rerun this math when those numbers land. Until then, our $2 billion wedding investigation is on screen now. Same rules. Every source in this film is dated on screen and linked below. Read them, check our math. That's the point. This is the viral feed.